I think with the schedules just in between, and maybe just how the calendar worked out this year, it's not Christmas wasn't over, New Year's isn't over a weekend, right? So there is a lot of days that are blocked off. I know lots of people anecdotally they weren't sure, or some people went to did a day of work last week on Friday. To your point,
Mm-hmm.
um, some are in the office today. Some will be here after New Year's.
So next year we're back to that. We've seen it many times before, where it's Christmas is Thursday, Boxing Day is Friday, 2 days a weekend, and then the next week you've got Thursday is New Year's Day, Friday is a work day, and then weekend.
Mm.
What's your preference? I actually like it when Christmas Day is a Friday, Boxing Day makes the Monday a stat holiday, and then the next week you get another 3 day weekend. But this, what we've gone through in the last couple of weeks, is kind of a little weird, where you got the weekend, and then you've got December 23rd, 24th, 25th, and 26th are holidays. You got the
Midweek.
Friday in the office. If you go to the office, I did. Then you get a weekend, and then today, tomorrow, I'm probably going to be working from home because it's kind of a part day anyways. Everything's closed downtown. Nobody else works. And then
New
another
Year's.
holiday. Yeah, what's your preference? Do you like to have these interluding weekends in the middle of the weeks, or do you like to have the holidays attached to the weekends for really long weekends?
If I was vacation planning, I'd probably go with the latter. So then you can kind of just wipe the whole week, right? And you know that everyone else is likely to do something similar. When you have those built-in long weekends, then it becomes a little bit more hit and miss as to the continuity of not only your schedule but other people's schedules, and even for that matter, school schedules as well, or in some senses, right? So, I somewhat selfishly, I'd probably lean towards the latter. What we're going through right now, it's a little awkward, but it allows for everyone to kind of do what their schedule best suits them without having to overly rationalize to others, I guess, right?
So, anyways, let's move on. This is our first episode of season 3. It's right now it's December 30th, but we're not going to publish this episode till 2025. So, Happy New Year!
Wow, Happy New Year! We're doing better than a lot of Netflix series.
Yeah, 3 seasons. Yeah, how many got canceled recently? But anyways,
and we've been renewed, so that's good.
Yeah, well, we decided our expenses aren't that high.
Yeah.
And actually, I did pay for Riverside for a full year, so we might as well do another season of this. So what we're going to do for our first episode here is finish off the series we started in the fall on financial advice for people in different age levels. And this will be the final one for people in their 70s and beyond. Last episode, we talked about the 60s, and I just want to, if anyone's catching this episode as their first episode in the series, and they are retired, there are a lot of things that we talked about in the last episode that pertain to people, all people retired, CPP, OAS, RIFs, how they work, and that one you can find at muhs.ca/FP60. This one, you'll find the accompanying blog post at /FP70. So anyways,
I would say as a lead-in into this is that holidays, being a time generally, we're with most people are with their families. I'm intrigued because, well, not that I'm always intrigued, but my parents are in their 70s. And I think a number of topics came up over the holidays organically that touched upon some of the themes that I think we're going to be speaking about. And while it might be day-to-day relevant to my parents, as a child of those folks, I also want to be able to help plan for them as a child, and be able to make sure that I can impart or pass along some information that they may not be necessarily exposed to directly. And so even if we may be in our 20s, 30s, 40s, 50s, what have you, there's likelihood that there's a generation of family or friends that are above us, and I think that if it may not speak directly to us, but it's going to directly speak to people around us. And so it may not sound like, oh, it's the 70s, I'm not 70. Why do I have to listen to this? I think it's mainly because we can certainly pass along that information and help those that in that first the generation prior.
Yeah, I mean, case in point, I was just having this conversation with my father. We're having some cappuccinos at the Italian Center, as we often do when he's visiting.
Yeah.
And talking about downsizing in terms of material possessions. And, I made the point that, if he doesn't sort of work towards reducing the amount of stuff he has, it's ultimately going to be upon my sister and I. An interesting response he gave me is, like, in terms of sentimental things, and, you can consider everything sentimental. He's not a pack rat, but
Oh, I'm sentimental. I'm totally
but
sentimental. I have stuff
yeah, and
from.
if you
Yeah.
have a bunch of stuff that does have sentimental value, and this is a conversation you might have with your parents is, downsize this, sell that, sell that. Well, it'll be easier for my sister and I to sell that after he goes than for him to do that while he's still living. And he doesn't care. But if it has sentimental value, it's good to still have that there while he's
Interesting.
alive. It
Yeah,
has
yeah, yeah,
value
yeah,
to him. It
yeah,
doesn't have value to
yeah,
us.
yeah,
So even if it's like things that are not worth anything, they're just, throw in the trash,
yeah. I've heard of that lots.
it's
Yeah.
easier for the descendants to do that than for the person themselves. So I mean, that's a conversation maybe if you're
Mm,
having with your parents.
mm-hmm.
Don't feel like they have to do that job for you. It's harder for them to do that job for you than for you to eventually do that. And the best way of going about that is somewhere in the middle. Don't have a whole ton of stuff when you're in your 70s and 80s, and don't leave that all for your kids to have a mountain of stuff to go through. But also, it's okay to have some of that sentimental stuff if it brings value to you. That goes
No,
totally
it's
off of our subject areas that we were going to talk about today. But
yeah. No, 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 no. But it's all resonating in the
yeah,
sense because uh, these are things that collect over our life, right? And
yep.
and there are reasons why they are still in possession, right? In some form or not, right? So ultimately, and like with estates in general, is that leaving it all with many untied loose ends can be very difficult, emotionally, financially, logistically to deal with, right?
Mhm.
For those that have to deal with it afterwards. So interesting point there.
Generally,
Yeah.
estate planning is an entirely other topic I think we would want to dedicate, and we have
Yeah.
dedicated a couple
Yep.
of
Yep.
episodes to that. We're not going to touch too much on that today. We would get to 2 hours if we really talked about everything estate planning wise. So we'll do
Mm.
some more in the future with our estate planner
Yeah.
here, Jeff, who's been a good help in past episodes.
Yeah.
But this is more about as you're living in your 70s,
Yeah.
some things to sort of be mindful of. And one thing that I touch on at the top of my blog post, and I do talk about this a lot, it's scams. Now, when we're talking about in our 70s, when you're in your 70s or older, you are target numero uno for scammers all around the world. And that sounds scary, right? Like if I get one of those scam calls, I answer the phone and talk normally on there. I'm not trying to play around with them. They hang up on me immediately. I'm not their target. But if you're answering that phone and that's some scammer and they're all over the world, there's no specific country anymore where they're coming from. It's organized crime, and a lot of those people, almost all those people who are making those phone calls themselves are basically almost slave labor in some kind of call center. So they're
Victims of
victims
crime
too.
themselves.
They are
Yes.
victims
Yeah.
of crime themselves. But this is because it's such a worldwide thing. It's rampant. And yes, 70s, 80s, 90s, you are target numero uno, and that's just something you have to be aware of. And anyone listening to or anyone watching or listening to this who has parents in that age range, keep that in mind too. Keep them aware. And the one bit of advice I can give around this is don't shut yourself off entirely to the outside world, thinking that'll save you from getting these calls, or you're too scared to go on the internet because there's
Mm,
all this scams. That's
mm,
another way how these things pop up. Recently, not recently, a few months ago, I guess my father had a question about something on his computer, and it looked like he had some kind of virus. And luckily, he did not act on this thing that popped up because it was a
mm,
complete scam. It was one of
mm.
these things, they just pop up, they say they're McAfee or whatever, and you've got some kind of virus, and you need to call this number or go to this link, and that's how you get scammed. The key things when it comes to your computer to avoid falling into too many traps there is keep it up to date. And a lot of people, especially once they get older, they have this computer from 10 years ago that's running fine, and so they don't feel they need to upgrade. You do need to upgrade that from time to time, because once it reaches a certain age, it's not updating your Windows operating system or Apple, whatever, and then it's also not updating your browser. If you've got a really
Mm-hmm.
out of date web browser, that's where you're going to put yourself at great risk.
But these are, technological layers that we can use, to engineer out some of the more obvious. You and I every month have to go through phishing or scam or IT security training,
Mm-hmm.
and
Mm-hmm.
it takes a few minutes, but it just reminds us that's topical that, hey, guess what? The reason why we have to do these things is because organizations have fallen prey to this, right? Somebody's clicked on that link to say, oh, my boss is asking me for money, or oh, this delivery hasn't happened yet.
Mm-hmm.
I mean,
Mm-hmm.
case in point, it's just, there was a big strike, postal strike, right? No doubt, if you haven't received, I'm just kind of flipping through my messages right now to see if I received something like this, but maybe in January they will know that, oh, there was a strike, postal strike. I highly likely, if I was a scammer, I would send a message say, hey, Canada Post sends you a note saying that your package hasn't been delivered yet. Please click on this to confirm your
Yep.
location, and
Yep.
then boom, right? And so it's social engineering around, something that's topical, it's relevant. Oh, it's concerning.
You make a good point. We go through that learning exercise periodically, twice a year, I think, and we're always kept up to date with what's going on. What is the latest way that they're scamming people?
Mm-hmm.
But when was the last time the average 75-year-old did that, if ever? If they
Yep.
exited the workforce 10 years ago or more, they've never done any type of cybersecurity training. And all they're getting really is, if they're keeping up to date on things online, then
Mm-hmm.
they're protecting themselves. And if
Yep.
if they're following what's going on, watch some of these YouTube videos. I think I linked one in my blog post about what the anti-scammers are doing. They're quite entertaining. And I'll just add one extra plug here. One other way that you can protect yourself is to subscribe to my newsletter at muhs.ca/newsletter. And every month I include a section there on scam schemes and terrible investment advice. And the purpose of that is to help keep people aware of what's going on.
Mm-hmm.
And I include some of the latest things that are going on, some links to YouTube videos. And the idea is too, if it's a younger person getting that email, to forward that on to their parents, making sure
Mm-hmm.
that they just know what's going on. And,
Yep.
and with AI these days too, like those phone calls, they're not going to come in with an Indian accent in the future. They're going to sound like your local dialect. And the scammers will put these scam calls out everywhere in the world in whatever language, and the person calling will sound exactly like someone local. And of course, we already know they copy those local numbers. Like I get the calls on my cell phone that are always the same first 6 digits.
Mm-hmm.
And the thing too, I mean, what I've warned my father about too is my voice is online through these podcasts, and someone could take all of the audio recordings,
Of
for
your
both of
voice,
us,
my voice, yes.
and call up our parents and pretend to be us, or call up our
Mm-hmm.
clients. And this
Mm-hmm.
is another thing where it is extremely important, and a lot of people are just not used to this. I was just watching Back to the Future on the weekend, and they were showing it on Crave. And Marty goes up to a phone book and looks up Doc Brown in the phone book.
Yeah.
The phone
Yeah.
book. A lot of people in their 70s grew up at a time when this was, it was normal to have your information so publicly available. All that
Mm-hmm.
phone book data got put online on Canada
Mm-hmm.
411 or wherever. And if you haven't updated it, your name, phone number, and address might actually be online somewhere. Most of us younger people, we only have cell phones, and we're just not listed at all. And you should absolutely, positively not have your phone number and name online in any way, shape, or form. And that means, make sure you're not listed there. Make sure if you're involved in any kind of volunteer group that they're not putting your information up like that. That if they ever, they shouldn't put it on a public website, call so and so at blah 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 to register for the fundraiser or whatever. That should just not be happening anymore. But it is, because a lot of people just they didn't grow up in that time when anybody around the world can get this information and can call. And if anyone ever found out that maybe you were a client of Canaccord Genuity, maybe you were a client of Justin or me, and had the ability to replicate our voice, and that technology is out there, they can call you up and pretend to be us and get you to put your money into crypto or something like that. Of course, people that know me know I will never tell them to invest in crypto.
Talk to
Anyways.
Justin about that. Yeah, no, but the idea here being is I think that there's more and more technology. The brave new world of all these new trends and AI in this particular sense, there's probably going to be a lot of good that comes out of it, and it's almost timeless, right? death, taxes, and scams. Maybe you want to add on to that.
Mm-hmm. Mm-hmm.
Maybe as a trigger, I would suggest that, and like when I was up visiting my parents over the holidays, I happily just double check their phones, just try to see what their software version was, automatic updates, that sort of idea. Trying to do a little bit of IT support is so much easier to do in person than it is to try
Mm-hmm.
to do over the phone with them. But simple things like that. And then now my mom, she will text me separately. What do you think about this? Just take a screenshot or something and send it to me. Or can you,
Yeah.
is this a scam? All right, because we've told her, like, double check. You
That's
don't
the
have to
biggest
answer
thing. Just be
anything
suspicious
immediately.
of those
So
pop-ups.
yeah, and just double check. Just
Mm-hmm.
ask somebody else, and say, what are your thoughts on this? Do you think this is a scam or not? And unfortunately, when somebody does fall prey to scams or the start to it, I think the general consensus is that through law enforcement is that it's severely underreported because for the most part, people are
Mm-hmm.
very embarrassed that they want to admit that they fell victim to
Mm-hmm.
something, right? To whatever degree, right? But if you're preemptive and preventative, and just that, if the technology and you're still on the filters and you're still uncertain, ask someone that you trust and say, what do you think
Mm-hmm.
about this, right? And get another human element, another human perspective on it, because I think at this point in time, it's still AI and other tools, the human feel, the human understanding of some things is still stronger, right? In sussing out the threats. So
Mm-hmm. Anyways, moving on from there. So again, we're talking about you're in your 70s. What do we do investment wise? Should we just put everything into GICs, get really super low risk?
this is a very interesting topic, right? It's a perspective
Yep.
thing, and I think through what was the work that you and I do, we have to make sure that the risk tolerances and the timelines of our
Mm-hmm.
clients are aligned with the underlying investments that they have, and so. For someone in their 70s, for example, right, actuarial tables say that you might be living 15, 20 more years, sort of idea on average. So, do you start investing only because you have 5 years left, 10 years left? Should you be ultra conservative to your point? Or
Mm-hmm.
do you actually have a slightly different paradigm change and say, you know what, I'm actually quite good where I am with living with a number of a certain amount of assets, but I got some other stuff that I probably don't need or I'm ultimately planning to give to my beneficiaries, my family, my
Yeah.
friends, my
Yeah.
charities of choice.
Yep.
And then
Yep.
that paradigm shift actually, I think, is an interesting, fascinating topic because most people assume, oh, yeah, 100 minus your age or 110 minus your age, that's your equity exposure. But it's not necessarily the case, which
I,
is why you want to have these conversations.
I was going to touch on that. That's the most inane rule of thumb of all of them.
It's a rule of thumb,
It's
but
it's
again,
right up there
average,
with
right?
the 4%, the 4%
The four
spending
percent rule,
rule.
yeah.
Oh well, that's not one that's going to hurt you at all. But
Yeah,
doing your age in bonds, 70%. If you're 70, you should have 70% in bonds. That doesn't make sense for the vast majority of people at that age range for those exact reasons that you mentioned, Justin. A lot of people in that age range probably they have enough money to retire off of. They should have a retirement income plan as part of a comprehensive financial plan with us. And then they know how much they will need. And we'll usually look at some contingencies as well. What if the markets do poorly?
the risk is that your risk tolerance may actually be greater than what somebody might initially think of somebody in their 70s, right?
Mm-hmm.
It shouldn't just be 100% GICs or money market funds or ultra conservative sort of investments. In some
And yeah, when
senses,
you
like,
when you have that retirement income plan, you've
yeah,
got this bucket of money for your retirement over however
yeah,
many years. And if you're
yeah,
super conservative, maybe a big chunk of that is in GICs, like a GIC ladder. So you've got enough
sure.
cash coming due every year, or it's in some kind of a mix that fits that time horizon, whatever that might
Mm-hmm,
be. 20 years,
mm-hmm,
30 years. I mean, 20 to 30 years is still a long time horizon.
mm-hmm.
If you're in your 80s, maybe you're looking at a 10-year for that money, but you're making sure that is fitting your need, and there's going to be enough to take into account inflation and all that. But then, yeah, you might have this other chunk of money, and that money should not be invested as conservatively as that if the goal is for it to go to your kids or other beneficiaries. And you bring up a good point. Charity, if the end goal is for a chunk of your estate to go through to a charity or charities of your choice through a bequest, that is what a lot of people do. And then that money, maybe should be invested a bit more long term. We talked was it last episode? We talked about donor advised funds, and we went into that in quite a bit of
Mm-hmm,
detail. So
mm-hmm.
go back to that one if you want to learn more about that. But the nice thing about donor advised funds too is if you prefer not to have a big lump sum go to a charity on your death, which creates a nice big tax credit at that time, which might be useful based on your particular estate situation. But maybe you don't need that big tax credit at death. Maybe you prefer to have smaller tax credits going along, and a donor advised funds lets you put money in year by year by year in smaller increments,
Mm-hmm.
building up that amount of money, and then it can go to the charity after death or however you want that to go out annually or
Mm-hmm.
whatever.
Yeah, if you don't have that conversation with your advisor or your plan to say, or your planner to say, you know what, actually, my TFSA, for example, this I'm planning to give to my grandchildren or my children.
Mm-hmm.
You need to be able to have that conversation and be explicit to say, you know what, because I'm planning it for my 20-year-old grandchildren, I want the risk tolerance and the investment profile to be more aligned with someone of that age, because
Mm-hmm.
if it's suited to it, it's going to go to them, and so it should match them and not necessarily me. But if you don't have that conversation, it may end up being just like, okay, we're going to put it to what is the stereotypical, whether rightly or wrongly, right? Profile that is suited for someone who is in the latter stages of their life, right? So,
Mm-hmm.
yeah, and it may, but perhaps you don't want to do that. But the point is you need to have that conversation, or the advisor should be able to bring this up to you and say, this is an option, this is an opportunity for you to actually do something, actually tweak it and build it so that it is more appropriate for the ultimate beneficiary who isn't you.
So with these posts at these different age ranges, the reason why I originally created them was I always found that people, if I grouped clients in these different age ranges, and I
Mm-hmm.
know not everyone's the same, so maybe some
Of
clients
course
don't
not.
like being grouped like that, but I tended to, over my years, find that people have similar tendencies in different age ranges.
Mm,
Like I said, 50s, more aggressive investors, you know,
naturally.
sometimes end up in those scam issues. People in their 70s, I've found typically, and it goes for people in their 60s as well, people as they approach retirement or in retirement, one of the biggest anxieties I think I perceive is this worry about you've got this money saved up, that you saved up your nest egg all throughout your life. Now you're going to start drawing from this money in retirement. And the scary thing is, I don't want to see that balance going down. And yeah, we talk about risk. That's, we got to manage risk a little bit to some extent, anyways,
Mm-hmm.
to reduce that volatility. We talked about that last time. But also, I don't want to have to ever sell principal. If I have a bunch of stocks, I don't want to sell stocks. I don't want to
Mm,
sell anything of a fund. I
mm,
want an income stream. I want yield coming from there.
mm, mm,
And there's a lot of advisors they latch onto this, and that's what they sell. They sell dividend strategies
mm,
and high yield investments. A lot of the fund companies, of course, they're offering things like covered call strategies and all these different private alternative investments. And a lot of times when I'm talking to the end investor in their 70s, the most important thing in their mind seems to be yield. And if I talk about a certain investment, sometimes the first question that comes up is, what's the yield? And I think there's two things at play here. One being the I want to get that yield. I want to have X amount of money, $1 million, whatever, and I want it to pay my retirement. Don't want to sell any of those stocks.
mm.
And then the other thing too is maybe when they plan their retirements 10, 20 years ago, probably more like 20 to 30 years ago, if they did planning early in their careers, they might have thought, okay, I'm going to invest in the markets all throughout the years. And that worked really well for them if they were, in that baby boomer age or older.
Mm-hmm.
It worked really well in the 90s, 80s, and 90s. But when I retire, I want to reduce my risk a lot. I just want to have bonds and GICs. And I'm happy getting 6% off those. Well, what happened is, with the exception of a short period of time in 2022, 2023, you didn't get 6% on fixed income investments. You got 2 or 3, maybe
Mm-hmm.
less.
Mm-hmm.
And so those same investors now are thinking, well, that's not going to work. And what else can pay me? Now they're looking at stocks and all this other stuff, looking for yield.
Mm-hmm.
And too often they're not taking into account the much higher risk that's usually involved in those types of investments. And they're seeing it too much like they're making a false equivalency between a stock that pays a dividend and an income investment that pays interest. Do you
Yes.
find that too? Or
Yep.
you
Yeah.
tend to
No.
have younger clients, right?
Yeah, I do. But still, to your point, I think recently there was, for whatever reason, mortgages, GICs, high interest savings
Mm-hmm.
accounts, because there was a period of time where the rates had shot up, right? And previous to that, it was ZERP, zero interest rate, policies and what have you. But 5% was this anchor that people mentally would go towards, either positively or negatively. And for lack now of basically nothing yielding 5% in interest, right? Whether it's a treasury or a GIC or a money market, they're looking for yield elsewhere. And
Mm-hmm.
I think one of those points to your, it's like you can't necessarily trade one for the other. I mean, you can think about some of the telecom companies in Canada or the utility companies in Canada,
Mm-hmm.
and they have a what seems to be a very good yield, and it's because, well, oh yeah, this is safe. I pay my cell phone bill every month. I have to pay my utility bill every
Perceived
month.
safe. Mm-hmm.
It's not going away, right? They're going to keep paying the dividend. Sure, maybe that's their policy because they know that underlying a lot of their investors are looking for income. But one of the reasons why telecom companies, some of them yielding 6, 7, 8, 10% yield, is because the underlying share price, the denominator, has gone down so much. And why has it gone down? Well, there's various reasons for each of these certain companies. But it may be growth, it may be debt, it may
Mm-hmm.
be an expansion or an acquisition that the market didn't like, so on and so forth. So the dividend might be stable or safe. They're still paying out $1 or $2 a year, whatever, what have you. But the share price has dropped down from $10, from $20 down to $15 to $12 to $10, and all of a sudden, something that was yielding 5%, a year or two ago in dividend yield, is now yielding 10% or 8%,
Mm-hmm.
9%.
Mm-hmm.
Yield hasn't changed. The income's still coming in every quarter. But guess what? That share price has changed substantially. And that's a risk. That's a real risk.
I found on top of that, and I posted a chart on the actual stock. I kind of hit it on my blog post, but it's actually Algonquin,
Mm-hmm.
which was for years and years a very popular utility stock, high yielding. And on top of that, with the price going down, causing the yield to go up, they too, the companies, were so compelled to always raise their dividend. And I show on that chart, I show the line of their actual dollars, their dividend going up.
Mm-hmm.
And for many years, the stock price kind of followed along. And these companies, because they know who their investors are, they feel so compelled to keep raising that dividend at all costs. And that
Mm-hmm.
cost sometimes is loading up on too much debt, creating a
Mm-hmm.
wonky balance sheet. And
Mm-hmm.
we saw with one of the telcos this year, they had to sell, they sold Maple Leaf Sports to their competitors so that they can keep paying their dividend. And that one has been turned into an absolute basket case lately
And who
in,
knows? Yeah,
in the
like beast.
markets.
Yeah, my cell phone bills through Virgin Mobile, which is owned by Bell Canada. Classic widows and orphans stock. If one had to pick one in Canada, in some senses, right? But at the beginning of the year, it was for almost $40 a share per share.
So
As of
lately,
recording today, it's at 22 and change,
so
right?
that's a
Like,
ton of risk. Like, yes,
so the
you're
dividend
right.
hasn't changed,
It's
right? You
kind of
still
a
got your
widows and
core, yeah.
orphans stock.
Well,
In
yeah,
long term
now,
history,
right?
it's been less
Yeah,
risky than owning
yeah,
Shopify.
sure,
But is that what you're willing to, the type of risk you're willing to take on as a
yeah.
75-year-old? If you're not getting 6% on a GIC, so you're going to
Hmm.
buy a telco, and it's got it, yeah, forward yield of 12%, but it saw its stock price from last year to this year go from 38 to 32. And or sorry, not just this month. Sorry, I got the years mixed up. That's just this month, 38 to 32.
Yeah,
The 1 year,
it's close.
yeah,
39 and change, right? But
that it's not. I'm
and
not
they
going to
may cut
judge that
it.
stock on
Yeah.
other merits, but it's not the same as putting money into an income paying investment, and that's what leads to the dividend trap, I call it. We talked. I think we did a separate episode on this in the past. I did a whole blog post on it. The other big issue too is
You
a
love
lot of
this
times
topic,
people,
yeah.
yeah. A lot of time I get this new prospect who comes to me in their 70s, and sometimes people are, when they're about to retire, that's when they decide they need to see a financial planner. It's often
Mm-hmm.
too late, but still better than.
Never. Yep.
And a few years ago, I was doing fee-for-service financial planning, and oftentimes these were the types of people I saw were in the 60s to 70s,
Mm.
and they just invested in their own stock portfolio. and perhaps the wife told them they need to see a financial planner just to make sure we've got all our ducks in a row for retirement. But anyways, I would often see these stock portfolios, and they were completely loaded in those particular companies: utilities, telcos, and banks. And those have been some really terrible investments in the last year or so, I think, compared to the overall market. But just generally, you're under diversified if you have no exposure to the vast world of investments out there outside of Canada, as well as the other sectors. And sometimes the response is those technology stocks are too risky for me. I'm in my 70s. I want a nice steady income stream. Well, you need to have those technology stocks in your portfolio to participate in the markets. And they, in fact, reduce your risk level. If you're only in those dividend-paying stocks, those high dividend-paying stocks, you're exposing yourself to not only the market risk, but also some of that interest rate risk and various other levels of risk, and just really business risk. What if the telcos all go out of business because Elon Musk creates Starlink all over the world, and that provides our telco for everything?
One of the underlying themes you said between the telcos and the utilities and what have you is that they all end up being Canadian telcos, Canadian utilities, Canadian banks, right? Like, you might have, two banks, right? But I bet you one of them's Royal Bank and the other one's maybe TD or BMO or what have you. Why not throw in a Goldman Sachs? Why not throw in a bank, from another country? Then you're while it's still in that financial sector, you're diversifying to a entirely different class of clients and financial services, right? Similarly, the telcos, you got TELUS and BCE and maybe a couple regional ones, right? But if you want to, diversify that risk, right, from that oligopoly, why not look at a telco from another country, a utility from another country? Different regulations, different rules, different customers, different geographic risk, et cetera, positively and negatively, right? And so might seem diversified to have three banks, but if there are three Canadian banks, you are not as diversified as you may think, right? So,
and those stock prices too, they
stretching that out.
reflect dividend growth. And if these are companies that are kind of already, like, the banks already are charging a lot in fees in Canada, the telcos, we know that wireless in Canada is more expensive than pretty much every other country in the world. Where's the growth coming from? Like, if if the stock price reflects a certain level of growth in earnings, growth in dividends, and if they're trading at anything less than 10 times earnings, which they are, trading at pretty high multiples, where's the growth coming from? There's no moat. One of the other garbage arguments that's made for these types of stocks is they have moats. The banks are an oligopoly, the telcos are an oligopoly. That's not something that is a positive for the future prospects of that stock. That's a moat that's going to be crossed. Constantinople had a moat. The Ottomans, they made it across. Like that did not make it valuable, right? There's another couple of other kind of false benefits, I say, of going dividend heavy. Now, with all this, I always try to preface this. When it comes to dividends, I'm not against dividends. Dividends are a nice side effect of investing, and a company that pays a dividend shows good financial management.
Capital allocation,
You know me as a proponent of dimensional funds, and one of the factors that they weight towards is the investment factor. Companies that are more conservative in how they invest their cash flows are to be desired, basically, or historically have had better returns. Conservative companies do not do massive expansions with all their money, spend all their money for growth, but they rather return it to the shareholders, dividends or stock buybacks. Those are strong companies. Again, not to only buy those companies, but those are strong companies to be weighted a little bit towards, but they should not make the majority of your portfolio. But on dividends, a lot of people they like the tax treatment in a non-registered account. In Canada, we have the dividend tax credit. And what a lot of people don't get is it's not really a freebie. It's not like the lower inclusion rate for capital gains, which is meant to incentivize people to invest in businesses, both stocks and private businesses. The dividend tax credit really exists because the government's already taxed the corporation at the corporate level. Same goes if you're a small business owner. That level has already been taxed. So when you, the investor, or you, the business owner, personally receive a dividend from that company, if as long as they're a Canadian company, if they've already paid tax, you get a credit for it. And so what happens when they calculate your tax level on the dividend income is first they gross up that income roughly to back where it was when it was corporate income,
Yep.
apply the tax credit for taxes already paid, and then you get taxed on that difference. And the end result is if you're at a fairly low tax bracket, anywhere in the, if you're in the 5-figure income range across Canada in most provinces, you're taxed pretty favorably. In some provinces, if you're, I think, less than 50,000, you're not even taxed at all on dividend income, or it might be 1 or 2%, what it works out to net. But just keep in mind that is not a freebie. It's just basically it's applied to taxes already paid. The thing too is there's a couple of other things that are sort of side effects from this. One is it is fully taxed. So if you have if your retirement plan includes collecting a whole bunch of dividend income, as opposed to owning stocks that don't pay dividends, where you just be selling some of those stocks to fund your retirement, 100% of your dividend income is taxed in some way. Following the dividend tax credit calculation, all that.
Yep. Yep.
Whereas if instead you have non-dividend paying stocks and you're just selling a little bit of them to fund your retirement, you may have a capital gain on it, but it's a capital gain on a small portion of that portion that you're selling. So rather than being fully taxed on your dividend income, having a 50% inclusion rate on a small bit of gain on that small bit of stock that you're selling is much, much more tax favorable. So when people say having a dividend stock portfolio as opposed to a portfolio of stocks that don't pay dividends, and I don't mean growth stocks, I don't mean going all into NVIDIA, but having a diversified portfolio where maybe the net yield on that diversified portfolio is 1%, as opposed to having a dividend-heavy portfolio with a 5% yield. You get what I mean, right?
So, yeah. One of the things about passive, in that it's some people consider it to be passive income. Like I'm getting a quarterly dividend check, right? I don't have to think about it. I receive the check every month. Or maybe even monthly. Canada as a whole loves their income, so it's come down for dividends or distributions are not just quarterly or even annually. You don't see annual distributions anymore, really, and they're all monthly. More and more companies and funds have switched to monthly income because the public seemingly has demanded it, right? But what I'm getting to the point there is that rather than receive something passively, it just shows up in your account every month or every quarter. The strategy that you're building upon, while tax efficient in a lot of ways, in your explanation, requires transactions, requires decision making, right? And this is where, which one do I sell? Do I sell the same one every month? Do I sell it every quarter? How many? Maybe the share, instead of 10 a month or 10 every quarter, I have to sell 12 this time, because the share price has changed a little bit or not, or maybe 8 this time, right? So there's decision making, there's processes involved in doing so, which is where I think some people might shy away from it. Like, they don't want to ask somebody. They don't want to ask a Marcus. They don't want to ask a Justin. Can you help plan this? Of course, yeah. But other people,
fully automate it. Yeah.
But they may not be right, or they don't have the ability to do so themselves through their self-brokerage, discount brokerage, or what have you, right?
Exactly. The self-directed investor, you have those frictions. One, administratively having to do the sell, and we don't want you to be tinkering with your portfolio all the time. We want you to enjoy your retirement. But if you're having to sell a little bit every month or every quarter, then that's doing that. And then it's a psychological thing too that I mentioned earlier is, what if you're selling a bit of those stocks every quarter and suddenly you sold the last few shares of whatever and you don't have it anymore. Now you're thinking, wow, I'm starting to run out of money here. That's not fun. And two, if the markets are volatile, this is another big, what dividend proponents are often in favor of is having a nice dividend stream, because those dividend income streams, they don't tend to fluctuate as much as the stock principal values. So
fair enough.
Markets can be down. You might still get most of your dividends. That's a good thing about dividends. But again, you have to weigh one versus the other.
Yeah.
Other thing I was going to mention too, in terms of that income and taxes, is the OAS clawback that results from that dividend gross up. So, and again, this is just if you are someone that's super, super heavy in Canadian dividend stocks, and that's the only thing you want to own, this is what you're doing to your tax situation. You are not only are you being taxed on that dividend income, but when they do that gross up that we talked about earlier, the gross up is what applies to your income when it comes to old age security
Mm,
clawback, which we talked
true.
about
Yeah.
a few episodes ago,
Yeah.
or last episode, I think. So again, if you want to keep your income fairly efficient, you you don't want to avoid dividends, but you just don't want to super overload in them. And I always
And
say
be only dependent on them.
yeah,
To your point. Yeah. Fair
and I
enough.
always say
Fair
they're a
enough.
nice side effect of investing. They should not be the goal at any age. Not because you're old doesn't mean you need to be all dividends. So moving on from
Yes.
dividends, what do we got left on the docket here?
Well, I mean, kind of touching on the point again, and again, I'm not going to go deep into this at all today. But some of the conversations that came up over holidays with the parents is that even the concepts of like reverse mortgages,
Mm-hmm.
is that what is
Mm-hmm.
it? How does it work? Healthcare being a particularly important one. Most of the healthcare costs for the person tend to be heavily weighted toward the latter stage of their lives, maybe even the last couple of years of their lives, right? When you think about it, assisted care, nursing homes, or even just any of those facilities of that nature are not cheap. They are very expensive these days. And so how to budget for that. And again, budget necessarily not just from the parents' perspective, but also potentially from the children's perspective, who are looking to potentially having to help out, their parents in those situations. Right. So not to get into,
Mm-hmm.
but just topics that came up organically through family holiday conversations, I think are going to probably likely came up with other people's families as well, and are worth considering, thinking about, planning for. And I think those are topics that you and I can speak freely of, outside of this episode, and maybe even episodes themselves to those situations. I think you
Yep.
have a guest in mind in the future for something just
Yeah, I
like
was going to
this.
mention that. Yeah.
Yeah,
Yeah,
but
at the conference I was
be
at in
mindful.
September, we heard from Chartwell, and they talked about the planning
Mm-hmm.
that should go into this beforehand. You don't just sort of like if you're in your 70s, 80s, whatever. You don't just all of a sudden decide, well, now I need assisted living, and you go sign up for it. You should plan for that years in advance.
Yeah.
Make sure you get a location that's suitable. And some experience over the Christmas break here with this. I was out delivering gifts to clients and delivered one at a I think it was a Chartwell residence, and I walk in there and people have this perception of the home, putting your parents in the home. And I remember this Sopranos episodes where Paulie Gautieri putting his mother into the home, and she's like super delighted, she loves it.
Yeah.
And then Tony Soprano putting his mother into the home, and she absolutely hated it and hated him, and just was so full of negativity. But I walk into this place and drop off the gift, and I find my client sitting there having dinner with some friends, new friends, because he just moved into this place a few months ago. And there's the social aspect of it for one. Being around, especially when either you've lost a spouse or your spouse is in dementia or whatever,
Yeah.
just to be around other seniors
Yeah.
and having that social aspect of your life. And I mean,
Yeah.
we went to university. Were you ever in a dorm in the university?
I was not.
Or
No,
you look because you went here in Edmonton. Like
I
I went to
commuted.
Boston, so I was
Yeah.
immediately in a dorm, and everyone I got to know there, almost everyone I got to know there, was through living in a dorm with people, and that's kind of like what you get to when you're older, and your whole social life might circulate around being in one of these
All the
retirements
hijinks of a dorm life.
places.
Yeah.
So
Yeah.
that can be good. That can be a good thing.
Mentally, socially, 100%. Absolutely.
Yeah,
Yes.
but yeah, plan in advance. Find where you want to go while
Mm-hmm.
you're still healthy. Talk to your spouse if applicable, and just
Or your
plan years in
children,
advance. And your kids, of
or your
course, yeah.
parents. Again, it's worth it. Have a pre-plan, and again, it's topical, timely. If it's not your family, it's families around you, it's relatives around you that are in this situation or will soon be in these situations.
Yeah, and it happens pretty quickly, and people age at different rates, and you don't know when that's going to happen. In your 70s, you could still be living the high life, and we talked about
Yeah.
this last episode as well. Is you want to be healthy in your 70s. One thing I cannot recommend more highly is while you're still able to, walking regularly. Again, I touched on it in the past. The name of the professor at the U of A who brought this up in my Rotary Club was Professor Mark Haikowski. I want to give him full credit. He talked to a room of Rotarians, many of them in their 70s and 80s, about just simply doing that 30 minutes a day of some kind of low level activity, just walking or taking the stairs from time to time, will significantly benefit you later in life. And while you're in later life too, just keep doing that to maintain some physical activity. And it'll be as simple as still being able to dress yourself in your late 80s or whatever,
Mm,
right? Like
mm.
it's simple things like that that this can make a big impact on. Um, and keep your brain active with hobbies and again social and all that kind of stuff too. It's the shut-ins that suffer the most, I think. With
It's cheesy enough, but that health is wealth phrase that you often
Mhm,
hear
mhm.
or people bring up is there's validity behind it, right?
I just finished reading over the holidays Daniel Crosby's new book, The Soul of Wealth. And one of the chapters literally is that right near the end, health is wealth. And again, that's a really highly recommended book, probably touching on a lot of this stuff too. And yeah, again, too, I mentioned this in the blog post. Service clubs, I think, are awesome. You should join any type of service club in retirement. It keeps you, it takes care of all that stuff: activity, mental acuity, the feeling of you still have an ikiga, that's raison d'etre. And yeah,
Purpose.
enjoy retirement too while you can. We talked about my mother, and the one uh, sort of the one solace I have in everything that went down in 2023 was the fact that she actually retired in 1999 from teaching. So at a pretty young age, at about age 50. So she had 20 years of retirement and did a lot of stuff, lots of travel and everything. And I just think of what would it have been like if she worked till 65, and then maybe even in first 5 years, maybe they felt they didn't want to spend as much in retirement. They were worried about spending money because, again, those psychological things we were talking about, that would not have been good. But she got a really great retirement, good 20 years or so, and yeah. And if
Mm-hmm, mm-hmm. Wonderful. It's the end of 2024. It's the start of 2025. We will be ready and raring to go for the new year.
All right, sounds good.
Happy New Year.